And joining us now here in studio, Donald Johnson. He is a philanthropist and a member of the advisory board at BMO Capital Markets, and we're very happy to welcome you to TVO.
I'm pleased to be here.
I want to start by just going through some of your background here, because we're not BNN here, okay? This is not a financial channel. Everybody in that world knows you. So let's just go through this. Philanthropist, investment banker, sit on the boards of many nonprofit organizations. Am I doing okay so far?
So far, so good.
So far, so good. I want to start by taking you back a couple of decades, because you wanted a change in the tax code as long as 2 decades ago that you thought would encourage more charitable giving. What was it that you were after back then?
Well, back in the mid-90s, I was chairing a fundraising campaign for the National Ballet Company to create a new home for the company down in Queens Quay. And when I was chairing that campaign, that's when I became aware of the fact that in the United States at that point in time, when you gave stock to a charity, you got a tax receipt for your donation, and you were exempt from any capital gains tax when you gave the shares to the charity.
So it was a great incentive to do so.
Right. Whereas in Canada at that point in time, when you donated stock to a charity, you were deemed to have sold the shares for tax purposes when you transferred the shares to the charity. So you triggered a capital gains tax when you made the gift.
Which is a disincentive to do it.
Exactly. And so the capital gains tax that a donor had to make at that time offset a large part of the benefit of the charitable donation tax receipt. So basically, nobody gave stock to a charity in Canada at that time.
So you went to Paul Martin, who was then the finance minister, and you said, look, this makes no sense. And what was his reaction?
Well, it took some time to make it happen. There was a real teamwork of people that appeared before the House Finance Committee. Rob Pritchard, President of the University of Toronto, Jim Pitt-Blato, head of the Sick Kids Hospital Foundation, Ann Golden, United Way, and Hal Jackman for the Arts. And we appeared before the House Finance Committee in their pre-budget consultations in 1996. And Paul Martin, to his credit, went halfway to the U.S. system in this 1997 budget.
And not so easy. You're missing part of the story here, if I may be so bold.
Yes.
His officials in finance didn't like this idea. They told him not to do it.
That is correct.
How come?
They were opposed to it. Well, they felt that it was going to cost the government tax revenues.
Which it would.
Yes. They felt that the government should make the donation where the money goes rather than the donor. They also felt that people who had donated cash to a charity had already paid tax on their cash income, whereas people giving stock have not yet paid tax. So there were some challenges there, and they recommended to Paul Martin that he not do it. However, to Paul's credit, and it's very rare for a Minister of Finance to go against the advice of his Department of Finance officials. To his credit, he said, let's do it. We'll go halfway to the U.S. system, and we'll do it on a 5-year trial basis. Because there was concern that the only benefits would go to the big hospitals, big universities, and not the smaller arts organizations and social service agencies like United Way and so on. So they did it on a 5-year trial basis. So by 2002, there was a clear demonstration that it was resulted in significant increase in donations, and that smaller charities also benefited. For example, United Way of Greater Toronto, which funds 200 agencies, social service agencies across the GTA, they were one of the bigger beneficiaries of this measure. So in 2002, the government made the 50% reduction permanent.
And then Jim Flaherty followed up, right? When the government changed hands? The Conservatives
yes,
went the other 50%.
We continued to advocate the government finish the job from 2002 right through to 2006. And then when there was a change of government and Jim Flaherty was the finance minister, Harper was the prime minister, in the May 2006 budget, they removed the rest of the capital gains tax on gifts of stock.
So you're a happy camper.
Yes, indeed.
Except,
and all 3 opposition parties were on side by that time.
Right. I say so you're a happy camper, except that you're not, because you're back knocking on the door again, saying the job's not quite done yet. So what's the next chapter in this quest that you think they ought to tackle?
Well, about 3 years ago, the C.D. Howe Institute had a conference on strengthening charity finance in Canada, and I was asked to get involved. Were there any other measures the government could implement that would stimulate more charitable giving? And this, at a time when we're having a lot of fiscal challenges, and governments are all focused on reducing their deficits and restraining spending or cutting spending. And so I did a fair amount of research on that, and basically in the United States, gifts of appreciated capital property are exempt. That includes listed securities, private company shares, and real estate. And in Canada, the exemption is limited to listed securities because there's a public market for the securities and no concern about valuation abuse. So what we are now recommending is that the government expand the capital gains tax exemption to include gifts of private company shares and real estate. And we propose to address the concern about valuation abuse by saying the charity can't issue a tax receipt to the donor until the charity receives the cash from the sale of the asset.
Just go into that a bit more. The valuation abuse meaning if people try to do what?
Well, because there's not a public market for private company shares or real estate, there's a concern in the Department of Finance, and it's a legitimate concern, that people could put an inflated value on the gift of the asset because there's not a public market. And there were concerns a while back about some art donations where there was artificial value placed on the value of the art, etc. So in the vast majority of cases, the charity wants the cash, they don't want to hold on to the private company shares, the real estate. They want the cash. They need the cash. So that's a very simple way to address any concern about valuation abuse, because the charity sells it for the best possible price, and charity gets the cash, and that's the value that should be attributed to the donation receipt to the donor.
Now, as with the previous proposal from 20 years ago, some people are coming forward saying there are risks associated with doing this as well. You've just identified one of them. Are there any other risks that would make the finance officials not want to implement this?
Well, the other challenge is that the mandate of the Department of Finance is to focus on reducing and ultimately eliminating the deficit. To do that, they're not going to increase taxes, as you know. So the only way you can reduce the deficit is by either cutting spending or restraining an increase in spending, and avoiding any measures that cost the government any tax revenues. Now, these two proposals would cost the government some tax revenues. So that's the other challenge from the Department of Finance's perspective.
And what are you arguing to get around that?
Well, I think we make a very compelling case. Gifts of listed securities to charities across Canada since 2006 have exceeded $1 billion every year. In the United States, listed securities gifts account for about 80% of the gifts of appreciated capital property. So roughly 20% is private company shares and real estate. So logically, it's reasonable to assume that there'd be about a $200 million increase in charitable donations if the capital gains tax were removed on private company shares and real estate. So increased donations of $200 million to charities. The question is, what would the tax revenue cost be to the federal government? And we've done an extensive amount of analysis, including the support of a former senior financial official who is now a senior advisor at one of the law firms. He gave me a lot of assistance in that regard. And the tax revenue cost to the federal government would be between 50 and 65 million.
That's not that much.
No. So, yes, the cost the government 50 to 65 million, but charities get 200 million of incremental funding at a very time when the federal, provincial, municipal governments are all focused on reducing their deficits. So the timing is right, just like it was in 1997 when Paul Martin was reducing the deficit federally and limiting the deficit, and that reduction in funding for health care, education, and so on was causing a challenge for the charitable sector finance-wise. The same situation exists today. All the charities are facing challenges in financing, providing their services, like particularly health care, where it's growing at 6% a year. but the government can't afford to increase funding by that amount.
Well, you say the timing is right, except that back at the end of March, I did read Jim Flaherty's budget pretty carefully, and I didn't see this in there. Did I miss it, or was it not there?
No, it was not there, but...
So he's not sure the timing's right either.
Well, no, I think he had a very legitimate reason for not having it in the budget, this most recent budget, because the House of Commons Standing Committee on Finance began hearings on tax incentives for charitable donations. They began the hearings in January of this year. I appeared as a witness before the committee on February the 7th. However, the committee is still conducting those hearings, and the hearings won't be completed until May or June.
So you got a shot at next year's budget.
Exactly.
You think?
So it's not unreasonable for him to make a decision. Well, he can't make a decision on changing the Income Tax Act before the House Finance Committee has completed its hearings and issued its report. So the hearings will be completed in the next few weeks. Following that, the committee will issue its report with recommendations. And I'd be very surprised and extremely disappointed if our two proposals were not included in their recommendations.
And I'm told you're the kind of person who people don't like to disappoint. Is that right? You're not good at taking no for an answer, are you?
I have three mantras. The sale begins when the customer says no. Persistence prevails when all else fails. And my favorite expression from Winston Churchill is never give up, never give up, never, never, never give up.
I remember that one, yes. Okay. And you never have you? Even when they've come at you many times and said, this isn't on. That just seems to put more juice in your sails, no, wind in your sails, and keeps you at it. How come?
Well, I think the benefits to the whole charitable sector are very significant. Just our charities play a crucial role in making this a great country in which to live and work and enjoy. And these measures would really help the whole charitable sector at a time when they're all facing fiscal challenges.
But I'm interested in the way you do things, because there are ways to change policy in this country, and a lot of times it involves getting 50,000 people with signs marching up Yonge Street saying, we want this. You don't do that. You're pretty quiet, actually, in the way you go about things. I mean, you might take some ads out, but I don't see you with picket signs in the streets ever.
No.
What's your approach?
Well, I take more of a grassroots approach. A good friend of mine advised me many years ago that it's very important to have the members of Parliament understand the proposal, the benefits of the proposal, and it's also very important for people in their local constituencies to communicate their support to their member of Parliament. So I have a list of about 700 business and community leaders across the country, most of whom serve as volunteer board members on a hospital, a university, an arts organization, in any way. And they have communicated their support in writing, as well as by phone calls or personal visits, to their local member of Parliament, regardless of which party that MP belongs to. And that, I think, has made a real difference. It's been a real team effort.
So last time, a decade and a half ago, you mentioned that you had basically all the parties supporting your idea. How are you doing this time round?
Well, I think, I'll give you two examples. The NDP, the official opposition, when I appeared before the House Finance Committee in September 2009 in their pre-budget consultations. At that time, Thomas Mulcair was the finance critic for the NDP. Mm-hmm. And during the Q&A session after my presentation, he said, and this is unanswered, that he had no questions. He fully supported these two proposals.
And presumably he still does as leader.
I would think so. I don't think he's going to change his mind. Okay. So that's extremely important that he is on record as being supportive. He's a former lawyer. He understands the benefits. So that's the official opposition to the NDP. As regards the Liberals, Scott Brayson is the finance critic for the NDP.
No, for the Liberals.
Sorry, for the, pardon me, for the Liberals, and he understands these proposals. He's a former investment banker. He understands the benefits and the cost, and he is also supportive. So if you have the leader of the NDP and the finance critic for the Liberals on side and being supportive, then that's a big help. In fact, it's one of the few public policy issues that all three parties can agree on.
We thank you very much for visiting us here at TVO tonight and telling us about your latest quest, and I'm going to remember that. The sale begins
when the customer says no.
That's a good one. Donald Johnson, thanks so much for your time tonight. Appreciate it.
I thank you for having me.
Support Ontario's public television. Donate at tvo.org.